Hello, good afternoon. My name is Sarah Hare and welcome to the latest BetaShares quarterly economic webinar with David Bassanese, our post-election economic update, much anticipated and hugely popular. So just before we get started today, I just want to remind everyone that everyone will receive a recording and the slide presentation will be emailed out later this afternoon. If you have any questions throughout the session, there is a widget on the side of your screen. Please just type those questions in there and David will hopefully get to them at the end. Also, before we start, just want to remind everyone that everything we talk about here is general in nature, and obviously before you make any financial decision, you should consult your financial professional, and we don't take into account anyone's personal circumstances. Our host today, which I'm sure you all know, David Bassanese, is BetaShares Chief Economist, formerly with the AFR, Macquarie Bank and Treasury. David is also author of the Australian ETF Guide. So before we get started, we've just got a quick poll, and first of all, wanting to know if people are surprised by the election result. So how are you feeling Sunday morning? And the second question we've got for you today is, do you think house prices have bottomed? We're at the bottom here, anywhere else to go? So just a quick yes, no. It's very topical at the moment. Okay, just some final thoughts on the house prices. All right, we'll close that. And then I'll just show you how surprised everyone was. So the majority of people were definitely surprised by the election result, as was Bill Shorten, I should think. So the second one about house prices, no. So very interesting. So Dave here, he sort of shrugged at that. So we'll get on without further ado. And Dave.
All right, thanks very much, Sarah, and thank you everybody for joining us today. Always interesting things happening in the markets and the economy, and certainly the last few months since the last quarterly webinar is no exception. So as per normal, this will be the agenda. So just some go through what's been happening in the global economy and a sort of a look forward there. Developments in the Australian economy, obviously covering the recent budget, some key takeaway. The election and some key investment implications arising out of the election, and then some investment thoughts, some investment ideas that result from all of that. So if we just press on to the next slide. Yeah, so just really this is a summary of what we've seen over the last few months. Got global equities and 10-year government bond yields. As you can see, we did have that sharp dip in the equity markets late last year. The S&P 500 was actually off 19.7% on a daily basis through last half of last year. On the back of, as you can see, at the time was rising interest rates. It was really essentially the fear of the Fed tightening, fear that the US interest rates would continue rising through this year that spooked the markets last year. They were fearful of the US recession. The market sold off. The Fed since pivoted, so the Federal Reserve, announced that it would go on hold, and no sort of increase for the foreseeable future. Bond yields peaked and started to decline, and as you can see, we've had a nice equity market rebound since then. So the S&P again peaked from trough to peak up until end of April was actually up 25%. Since then, we've come off a bit, so the S&P 500 is down 5.5% from its peak at the end of April. So a bit of a seesaw, and essentially the relief we've had that the Fed had paused interest rates in the US has now turned to a bit of concern with the trade wars, I guess the re-emergence of the trade tensions between the US and China. And just on that, some comments. Obviously, this is the big focus at the moment. If you go to the next slide. Just again, this is something I brought up last year. The direct effect of, we're really looking at the worst case scenario that was discussed last year, 25% tariff on all of Chinese imports or goods imports into the US, which is about 500 billion. That works out about 0.6% of GDP. So look, not insignificant, but nonetheless something that the economy should weather, at least as a direct effect. And I guess what we're seeing here, I guess when my argument last year would be, I think a trade deal would eventually be done. If push came to shove, Donald Trump would accept a deal rather than risk, a big equity market sell-off or a potential negative impact on the economy. He's shown more resolve than expected, I guess, in the last, certainly the last few weeks. He's backed away from the deal that did seem to be on the table, partly in response to the Chinese seemingly reneging on some of the agreements. So it seems. I mean, we only read what we get told from the media reports. And I guess he was heartened by the fact that the equity market had rebounded. So where does all this mean? Basically, I guess one concern here is that things may need to get worse before they get better. I mean, it may well be the case the equity market needs to sell off a bit more. We need to see more weakness in the economic data potentially arising from this trade standoff before at least Donald Trump, either side's got to blink. It's unclear how that will happen. And I guess one other issue is that the Fed put, I guess the idea the equity markets aren't selling off as much as you might expect because they're also now toying with the idea that the US Federal Reserve could cut interest rates later this year. So that's sort of supporting the market. So people are reluctant to sell off the market because they may, it may well mean that it increases the risk that the Fed may cut rates to support the market, oddly enough. So we're in this sort of standoff situation. But look, I don't have a lot to shed. I mean, we're really just watching day to day in terms of how the brinkmanship between the US will play out. I just obviously point out it's certainly a major risk factor over the next few months. Just looking at some of the numbers in detail, this is just a snapshot from my weekly what's called Bassanese Bites. It's a weekly email that comes out on a Monday morning. If you don't get it and you are interested in a snapshot of the market, certainly sign up for it. But this really just a summary of what's been happening over the last few months. If you look at the 12-week change, so like over the last 3 months or so, the markets are off, well, net, not much, but they've obviously declined in the past month. Just interestingly, the Australian market has actually held up reasonably well in recent months on the back of, as I'll be talking about later, heightened expectations the RBA will be cutting interest rates over the next few months. We've seen a pretty substantial decline in bond yields. If you look at Australian 10-year government bond yields, they've declined by 63 basis points over the past 12 weeks. So quite a substantial decline now, down to around 1.5%. Aussie dollars come off, it's broken down under 70 cents. And that's despite the fact, if you see at the very last line, ongoing strength in iron ore prices. So we've had very, strong commodity prices, at least for Australian exports, but the negative interest rate effect has been the ultimate factor that's weighed on the Aussie. But the Aussie would be a lot weaker were it not for the strength in iron ore prices. Just looking at some of the, I guess this is if you wanted a single indicator of the health of the global economy on a monthly basis, it's probably this. This is what's called the Market Global PMI Index. So it's a summary measure of manufacturing and service sector surveys across the major developed economies. And really, I guess the shaded area there is that when it's between 50 to 55, it shows, reasonable growth. When it's a lot higher than that, it's showing, pretty strong growth, and below that, weak growth. So I've sort of, tongue-in-cheek there called it the Goldilocks zone. And as you can see, we've been pretty much in that for the last few years. But since early last year, we've been on this weakening trend, and certainly in the manufacturing sector, there's been this weakening trend. We're not yet broken below 50 on this measure. But I guess ultimately it's been the trade tensions which have seen sentiment and activity in the manufacturing sector in particular start to soften. So that certainly bears watching over the next few months. If you look at it from more country-specific detail, as you can see, firstly, it's really the composite index. That's basically manufacturing and services. That's all of those indexes for the major economies still in the, I guess, the Goldilocks zone. But manufacturing generally has been the weaker sector because that's been most hurt by the cutback in international trade and the tensions between the US and China. And as you can see, Japan, China, and the Eurozone, the manufacturing indices are now below 50. So US is holding up relative to non-US markets, but US is, as you can see from that blue line, has started to follow, and it's getting perilously close to that 50 level. So, manufacturing is on the back foot globally. So far, it's been particularly evident in the non-US markets, which are, I guess, more trade exposed. I mean, Japan and Europe, the share of exports are a bigger percent of GDP than in the case of the US, and a lot of their exports do go into China and Asia more generally. So, again, something that does bear watching over the next few months. Just going around other parts of the world, obviously the UK is another source of tension. Look, I've often downplayed this. At the end of the day, UK is still a relatively small part of the global economy. So I don't think in and of itself, even if it does have a hard exit from the EU and a lot of economic dislocation, I don't think it will have big spillover effects to the global economy, potentially some spillover effects to Europe, but mainly concentrated in the UK. So really the update there is Theresa May had failed to come up with a deal that Parliament could accept. She has now, decided to resign. There's a leadership tussle going on. There'll be votes by the UK Conservative Party, and a new leader will be elected by the party by July 24th. It's looking like Boris Johnson is the front runner at the moment, but basically it's looking like hard line or, people very keen for Brexit is likely to be the new leader. And Boris Johnson has basically said he will come up with a deal by October, deal or no deal essentially. If he can't get a deal with the EU, he's prepared to basically exit without any deal. So he says at the moment, but, we'll see how that plays out. So, as the title says, UK does appear it's getting closer to a hard exit with no agreement in place. And the modelling there, at least from the Bank of England, does suggest that would be the most disorderly outcome for the UK. What I would say also, though, is if the economy does, stumble and potentially fall into recession in the UK, it could actually be the bargain buy of the century. I'm actually very positive on the UK economy once it extricates itself from the EU and gets through its transitional problems. So again, it's an investment opportunity that does bear watching over the next year or so. Europe also, and just talking about Europe in general, it is plagued by some problems. Italy remains Europe's problem child. This is a chart of government bond yield spreads to German spreads. So basically, when these spreads widen out, there's a risk of, a country risk in these countries. There's a risk of debt default or risk of countries, potentially even leaving the EU. So you can see the Greek spread has come in, hasn't really blown out recently. So the Greek, debt situation seems to be under control. But the new government in Italy is pressing ahead with a budget deficit which is bigger than the EU has agreed to. Problem with Italy, though, is the budget deficit blowout is largely because of the weakness of the economy. So it is hard to ask Italy to tighten its belt when the fiscal deficit is widening because of the weakness of the economy. Italy is unfortunately also planning to, scale back on pension reforms, has a lot of inefficiency in its public sector, but there's no real appetite to tackle that. So it does remain the problem child of Europe. But again, ultimately, at the end of the day, the global markets are only really concerned if there's any risk that Italy would leave the EU. And there's still certainly no, I think, risk of that. The appetite in Italy for that remains quite low. So they're really trying to have their cake and eat it too, stay in the EU, but run a bigger deficit than the EU would like. But again, I think that a bit like Brexit, it's an issue, but I don't think it's something that would necessarily spill over more broadly to the global economy. I think Italy and the EU will eventually come up with some deal. well, they'll essentially have to, and ultimately probably the EU would relent and let Italy run a bigger deficit than it's currently being allowed to run. Better news, I guess, again, the big picture for me is still the US economy. It's still the biggest economy in the world. Wall Street still drives what's happening in global financial markets. And the good news here is, despite all the trade wars, the economy is still going along pretty well. So a key forward indicator of the US is weekly jobless claims. As you can see from this chart, it's still trending down, so the labour market is still looking quite good. If you go to the next slide, the unemployment situation, I mean, again, regular listeners in on these webinars will be familiar with this chart. It's the state of the US labour market. The unemployment rate is now down under 4%, so the labour market is tight. Wages growth, it has started to accelerate, but certainly over the last few months, there's been no further acceleration in wages growth. So it's running at just over 3%. The line in the sand, or the time we get worried, is when it pushes up to 4% or more. And that's when the Fed, I think, would have to conclude the labour market is potentially an inflationary problem, and the Fed would need to no longer be patient and may well need to raise rates. But we're not there yet, and the good news is that wages has seemed to stabilise over the last few months. Now, if the economy in the US does slow back to more of a trend pace and the unemployment rate, levels out around these levels, that would actually be a pretty good Goldilocks scenario for the US economy. So, so far so good. And the fact that wages has still remained benign, along with just this very strong competition in the US economy through technology, globalization, these sort of structural factors. Inflation in the US does remain quite low. The red line there is the personal consumption deflator, ex food and energy. It's and it's actually the key indicator the US Federal Reserve targets. That basically it doesn't want to see inflation running at 2% or more, and at the moment it's certainly that red indicator is comfortably below 2. It's actually running at 1.7. And in fact, there is some talk amongst Federal Reserve members that they could, if inflation stays sub 2%, there is some risk that they could even cut rates later this year. The markets, I think, have gotten a little bit ahead of themselves. They are pricing in interest rate cuts, but I think the challenge is inflation is low, but the labour market, going back to that previous chart, is very, very tight. So my base case is I still don't think the Fed will cut rates later this year, but that the markets are certainly starting to think about that. In terms of the markets themselves, the other, I guess, pleasing aspect of the US economy in recent months has been earnings expectations have been holding up reasonably well. They did take a hit. This is just a chart of earnings expectations on a rolling monthly basis for, I guess the focus is 2020 and 2021. And as you can see, they took a hit late last year as those trade wars intensified, the equity market sold off. And broadly, they've been holding up over the last few months. And at the moment, expectations would be consistent with forward earnings, which is that dark line, rising by about 12% over the next 12 months, and about 10% by the end of the year. So there's still some tailwinds coming through from the earnings based on expectations. Now, I think there will be some further moderate downgrades in earnings, such that earnings, instead of saying rising 10% over the next 12 months, might rise only 5%. So I think that'll be a halving, but nonetheless, still holding up, still positive. And if you look at, I guess, the other way, the other focus on the market of valuations, and the first chart there is the prices and the earnings. As you can see, earnings have flattened off the forward earnings measure, but again, in recent months, have started to lift back up again, and I think that can grind up a little bit higher. The other thing that will drive the markets is the PE ratio, and as you can see, the market over the past 15 years or so, it's never been above 18 times earnings in the US market, and it's sort of been the line in the sand. certainly the markets peaked out at 18 times earnings earlier last year. Before the recent sell-off at the market peak in late April, that PE ratio did hit 17, and it's now fallen back down to 16. So we're in that, the PE ratio at the moment, again, this is a price to earnings ratio, is in the range that it's been in over the past few years. So at 16 times earnings, it's not sort of flashing expensive. It's at reasonable value. And the other thing to bear in mind is that with interest rates low, so if you look at the 10-year bond yield there, it's running at around about 2.5%, or actually 2.25%, I should say. The equity to bond yield gap is, it's at a reasonable level. It's actually at 4%. Longer run average, it's at the lower end of the range over the last few years, but from a longer run average, it's certainly comfortably above the average over the past 10 to 15 years. So all up, valuations in the US at this stage still not flashing red. They're not cheap, they're not expensive, they're sort of in this fair value range, held in by still quite low interest rates. So that in and of itself at this stage is not a huge concern. It would be a concern if the equity market did rally strongly from here and we pushed up to 18 times earnings. Then, it's a question of, will low interest rates justify pushing up through 18? And that will be the question we will face when that happens. But at the moment, but earnings are looking okay, valuations are looking okay, so I wouldn't be super bearish on the market based on those fundamentals. Looking at the Australian economy, obviously, let me just focus firstly on the election outcome. Look, I guess the key implication for investors is the fact that the Labor Party didn't win, and the Labor Party were, they did go into the election campaign as a big target. As it was told, they did have some pretty aggressive tax policies to end the refund on franking credits for some investors, to abolish negative gearing on established properties, and to halve the capital gains tax discounts from the assets held longer than 12 months, from a 50% discount to a 25% discount. Now, the Labor Party didn't win, so all those fears have now basically diminished, and I think franking credits are really here to stay for the foreseeable future, and so are negative gearing provisions. We will see some tax cuts over the next few years as well, and in fact some tax cuts are coming through over the next few months. And I think the end of election uncertainty should provide some support to business sentiment. We've certainly seen a turnaround in the property market of late, which I'll talk about in a minute. But I think they are the key takeaways, and just to delve into those a little bit more. Some of the key winners. So as I mentioned, really it's not that there's new policies, it's just relief that potentially negative policies in some areas won't go through. And given the expectations, as we saw from our survey, the general expectation was that the Labor Party would win. So a lot of the tax proposals that the Labor Party were talking about had effectively been started to be priced into the markets. So preservation of negative gearing and capital gains, obviously good news for investment property market, the real estate sector. Also, the preservation of franking credit refunds are very good for investments that offer, not only high yield, but high franking credits as well. So areas like hybrids, which I'll be talking a bit about later, and, good franking, high dividend paying Australian shares. And longer term, just the preservation of capital gains tax concessions, that does, bode well for just longer term investment in share markets and property markets. So, investing for long-term capital growth, is still a very good, it still bodes well. You're still going to get that nice capital gains tax discount. Of more immediate impact for the economy are the tax cuts. And again, there's been a low middle income tax offset. Basically, the budget introduced a $500 a tax credit for taxpayers on low to middle incomes. And during the election campaign, that was boosted up by another $500 to effectively $1,000 or $1,080 to be exact, for taxpayers in the between $45,000 to $90,000 tax bracket, which is about 4.5 million taxpayers. So pretty, decent whack. Those on less than 45 do get a tax credit as well, not as much, and those above 90, up to 125 also get a credit, but it phases out. So again, we're looking at, as people fill in their tax returns and submit their tax refunds, they'll be paying, up to $1,000 less in tax than they would otherwise be. And if they're getting a tax refund, they'll be getting $1,000 extra, up to $1,000 extra. What does all that mean? The RBA has done some calculations. It estimates it'll be about 0.6% contribution to household disposable income, which is nice, which is good. It's better than nothing. But if you actually look at it, the RBA is still forecasting quite weak consumer spending this year due to the drag from the housing sector and a slowing in employment growth, which I'll talk about next. So the stimulus is useful, but it doesn't change the reality that growth is likely to be quite a bit softer over the next 3 to 6 months. And that's why I've actually argued, if anything, the government could bring forward some tax cuts. It's talking about cutting the higher income tax brackets over the next few years. Maybe we could bring that forward. This is what the orange line is the income tax bracket as of at the moment, and the dashed line is what it will be by 2024, phased in, one in 2022 and then in 2024. So as you can see, most people in that middle to income, low to middle income, I guess 200,000 is pretty high, will be dropped from about, around about 36% down to around 30%. And basically the objective here is that by 2024, something like 94% of taxpayers will face a marginal tax rate of no more than 30%. So there'll effectively be only 3 income tax brackets: 19%, 30%, and then 45%. But to be on the 45%, you'll have to be earning over 200,000 by that stage. So if we just go back to the previous chart, and why is this important? I think this is pretty interesting. I took this out of the budget papers. If you look at it, Australia has a relatively high top tax rate, 47%. It's broadly similar to the UK and Canada and the US, a little bit higher. But the big difference is that it cuts in at a relatively low income. So the top tax bracket in Australia at the moment cuts in at about 2 times average income, whereas in the US, for example, it cuts in at 8 times average income. So you have to be on, quite a big income to pay the top marginal tax rate. Now, all the change, and in Canada and the UK, it actually cuts in at 4 times average earnings. So that is the really big difference between Australia and other countries. Now, what it would mean, if there were no change in the tax rates, that would actually get worse. So the top tax, the top tax bracket would cut in at only 1.7 average earnings by 2024. With the changes, it will cut in at 1.9. So funnily enough, it will still actually be lower than it is now, but not as low as it would be. And so effectively, the government is giving back some of the bracket creep that it will earn over the next few years, but not all of it. So I think it's just very interesting that, how it does, even with all the tax cuts, which are good, the top tax bracket will still cut in at a relatively low income compared to average earnings compared to the situation in other countries. And just on that also, I thought this is something the RBA mentioned in a speech a few months ago about why household income growth has been weak in the last few years. Look, partly it's been because wages growth has been weak, but it's also been because the tax take has been increasing. So as you can see there, the tax to income ratio has been trending higher, and again, it's because of that bracket creep. People have been moving into higher income brackets. And their average tax rates have been increasing. Looking at the economy in more detail, basically we still do face some balanced forces, I guess. There's some positives and some negatives. The positives are the infrastructure boom is still going on. Public and private infrastructure rollout continues. I guess the one concern there is infrastructure spending is already at a high level. And it's probably not going to grow a lot more from where it is, but it is going to remain at a relatively high level. We are seeing a bottoming out in mining investment, and in fact, we just got an update to the what's called the capital expenditure survey this morning at 11:30, and it did show a modest further upgrade to investment intentions for next financial year. So business investment does seem to be coming through, and mining investment appears to be lifting again after having declined for several years, albeit only modestly. And basically what mining investment is lifting because the big capacity expansions, the growth in mines over recent years, they've now got to spend money on maintaining those mines and those resource projects. We've also got a service boom going on. The healthcare sector, the disability care sector is booming, partly on the back of the rollout of the NDIS, National Disability Insurance Scheme. And also underpinning everything is continued relatively strong population growth. So again, both sides of politics going into the election still favoured pretty high rates of immigration, and they are going to, continue to underpin growth. Something like 1.7% growth in population coming largely from immigration. Economic negatives is the housing sector, and again we're now basically facing quite a notable downturn in housing construction, and also the wealth impact of weaker house prices on consumer spending, and consumer spending is 60% of GDP. So if consumer spending slows a lot, it's going to have a big impact on GDP growth. And just to have a look at some of those, this is a slide on the next one. First chart is the peak to trough declines in Sydney and Melbourne house prices. I've used ABS data historically, and I've updated it with a monthly series from CoreLogic. They put out monthly data, so it's updated to as of April. As you can see, the Sydney market is now off something like 15% from its peak, so it's a pretty hefty move by historic standards. And Melbourne is off around about 12% or so. Also, as you can see from the following chart, building approvals, so the construction of home building, we had a nice run up from 2009, and it held at a pretty high level over the recent years, which is very timely at a time when mining investment was declining. But now that has started to decline. And in fact, if I flick to the next slide, you'll see that in more detail because this is a more updated chart of building approvals. So just focus on that first slide, the lower left slide there is building approvals. And I can tell you again, we had another update this morning. Building approvals were down another 4% in April. So that line will tick down a little bit further. So we are seeing an unwind of housing construction. Looking at some other indicators, the NAB business survey, so business confidence is also, look, it's not bad, but it's certainly not at the levels that it has been earlier last year. And that does remain under some downward pressure. The unemployment rate has ticked up from 5% to 5.2%, and again, my call is that's going to gradually trend up to at least 5.5% and probably 5.75% over the next 12 months. And that's consistent with the view that hiring intentions are starting to unwind. As you can see, the ANZ jobs series there has started to roll over a little bit. So the indicators for the economy have started to weaken, and again, largely led by that housing downturn and the softening outlook for consumer spending. On the inflation front, I mean, before the slowdown in the housing sector, we did face a situation where wages growth remained quite weak. Inflation still sub 2%, and again, now with the downturn in housing, that situation's unlikely to change. So inflation is going to remain pretty subdued. And meanwhile, as I said, if you just go to the next slide, this is a slide I've shown in the past, how consumer spending in recent years has held up relative to income growth, largely because the savings ratio has been run down. But if you look very, very carefully, that's the December number there. There's been a slight uptick in that savings ratio in the December quarter, and that's why consumer spending has started to slow. And I think that red line is going to tick up a little bit more over the next few quarters, and we're going to see a further slowdown in consumer spending. So again, that's why the RBA, even though we're getting some tax stimulus this year, is forecasting only 2% growth in real consumer spending in 2019 versus 2.75%, 3% in the last few years. What does all this mean for interest rates? Back in early February, I did say that the RBA, I think would now start to cut interest rates. The market has sort of, swung round to that view in a very forceful way in the last few months. And in fact now I'm saying I think the RBA will cut rates to 0.75% by year end. So I think it's virtually certain they will cut interest rates next month. And then again, say in August, when they do their next quarterly statement of monetary policy, they usually like to tie rate cuts around their quarterly statements. I actually did say that the RBA, I thought they would cut rates as early as last month because I didn't think they would be swayed by the election campaign. I was wrong. They were swayed by the election campaign and they held off, but they are now, and partly because there's a new governor. I mean, they have moved rates in election campaigns in past, but it was under Governor Stevens, and this is a new governor, so I guess, the new governor was a little bit more politically sensitive than the previous governor. But all that said, they have now signalled pretty strongly that they're likely to cut rates next month. And also, what's interesting, also the forecast that the RBA put out a few weeks ago in their quarterly statement, they had pretty weak growth forecasts. And that was already factoring in 50 basis points or 25 basis point rate cuts that the markets had already priced in. So their growth numbers were weak, even with anticipated 2 rate cuts. And so that's why I'm now thinking that, I think they will cut by at least 50 and probably a bit more. So I'm saying 75 now. And, there's some out there saying at the moment, economists are sort of, trying to outdo each other in sort of bidding how far the RBA is going to cut rates. They could easily cut rates a bit lower than that. I think JP Morgan got a few headlines yesterday saying they could cut rates to 0.5%. And you certainly couldn't rule that out, depending on how weak the economy does play out. But, we've had a nice rebound in the housing sector. That may give them some pause. And as I said, there are some elements of the economy that are holding up, and I don't think it's, we need to get overly gloomy really about the outlook. On house prices, as you can see, look, the Sydney market has corrected from a valuation. I won't spend too much time on this chart, but I just focus on the Sydney market, the affordability measure there. It basically fair value. The market in Sydney is cheap when the affordability ratio on this drops to around 30. When it's over 40%, it's expensive. So it has dropped back under 40%. As based on the latest monthly numbers that I've plugged in there. I've just done some figuring there. If you look at, if the RBA does cut by 75 basis points and it's fully passed on by the banks, then I guess the discount variable mortgage rate would drop from 4.6% to 3.9%. And in fact, the affordability ratio would drop a little bit further down to 35%. So that's midway between that 30 to 40% affordability measure there. So that's a measure of home loan affordability. And actually, you could argue the market would then be fair value, would you believe, with that affordability measure, somewhere between 30 to 40%. So there is an argument to say if the RBA does cut rates, house prices could well start to bottom out because they would start to look reasonably, well, at least not super expensive given mortgage affordability. The only problem, of course, with that is that it's based on a cash rate of 0.75%, which I think over the long run will not be very sustainable. I think the RBA would still anticipate a long-run cash rate of at least 2, possibly 3%. So that's still going to be a headwind for the markets over the next few years. So I wouldn't count on a strong rebound in the Sydney property market. Melbourne market also, look, actually the Melbourne market's not... affordability-wise, not as overpriced as the Sydney market. With rate cuts, it may well, start to look reasonable value as well. But again, heavily predicated on the fact that it's based on very low interest rates. Aussie dollar has broken down under 70 cents. Look, it's probably going to weaken a bit further if the RBA does cut by 75 basis points. I think 65 cents by year end is a reasonable forecast. What's interesting, if you look at the second slide there, the interest rate differential between the US and Australia has been narrowing quite significantly, but iron ore prices, which is usually a big driver of the Aussie dollar, have remained incredibly strong. So net, that's really what's been holding up the Aussie. It would be a lot weaker were it not for the strength in iron ore prices. Just in terms of our market, just to highlight our market valuations, to compare this with the US. PE basis, we're around about 15 and a bit times earnings. Not that bad by the standards of recent years. So you could argue our market is not, reasonable value. And also, if you look at the fact that bond yields have dropped so substantially, so the 10-year bond yield in Australia now is down around about 1.5%. The equity valuation relative to bond yields in that lower right-hand slide is starting to look quite attractive again. So the yield plays in our market, I think, are coming back to the fore, and people will certainly start chasing yield in the Australian equity market. Just to conclude with some thoughts. Firstly, where are we in the cycle? Look, I still think we are late cycle. I think we had a lovely bull run, equity bull market from 2009 up until early 18, which is a time to sort of be overweight equities, overweight growth assets. I'm not saying the market will correct in a big way, but I think the gains going forward will be somewhat muted, and there's a more downside risk than upside risk going forward, simply if only because of the tightness of the US labour market. And I think the eventuality that possibly wages will rise and or margins will come under pressure in the US. But so that's a situation to be, at least we have neutral exposure to equities within a diversified portfolio. I wouldn't be super bearish at the moment, and I'm really waiting on some of those lead indicators in the US: jobless claims, wages growth, the Fed to tighten. I wouldn't get bearish on the market until we started to see some of those move into more dangerous territory than they are at the moment. Some investment ideas. This is again one from the last quarter, but I still think it's a good idea. Quality stocks. So we have an ETF that tracks companies that have high return on equity. They are termed quality companies in the investment jargon, and as you can see, quality has outperformed versus the global benchmark. Quality companies has shown good outperformance over the last few years, and even in periods of equity market weakness, that outperformance. Quality does at least as well, if not better, than the overall global equity market. So, and it's certainly panned out again over recent months. So, if you want some exposure to global equities, something that has been doing well and should hold up relatively well, even if the equity markets suffer a pullback. I mean, that still may well decline if the equity markets have a sharp sell-off, but historically, at least, have not sold off by as much. Is quality, and the ETF there is QLTY. In terms of the income opportunities, again, a familiar chart to many of you, I'm sure, just highlighting the various income opportunities that we can offer through ETFs. Now, the yields here have all come down in a big way over the last few months. So, for example, our long duration corporate bond ETF, CRED, is offering a yield of around about 3.4% now, down from just over 4% even three to 6 months ago. So, but the focus is compared to other yield alternatives in the market, such as bank deposits, such as a plain vanilla exposure to Australian, the Australian fixed income. If you the benchmark bond index in Australia, what's called the AusBond Composite, 75% of that is Australian government bonds, which are typically pretty low yielding. That's offering a 1.7% yield. If you just got plain vanilla exposure to bonds through, say, a plain vanilla fixed income ETF, you're getting pretty low yields. So, we offer certainly attractive yields vis-a-vis bank deposits. So the AAA cash ETF still offering about 2%. Again, if the bank deposits come down, that may well come down over the next few months. Coupon offering a nice pickup above that. Long duration bonds, and also hybrids. And, again, I've mentioned hybrids are still offering quite an attractive yield relative to other things in the market. BNDS, that is that's a partnership with Legg Mason. That's more of an actively managed fixed income fund. And its goal is to outperform the AusBond Composite. It does have an overweight exposure to credit bonds, and that's why it's offering a yield at the moment slightly more than the AusBond Composite. So that's the income opportunities. In the equity market, some ideas here. Inc. is it's basically an actively managed fund. which we have helped brought to the market. It's managed, it's a part of the Legg Mason stable of actively managed funds. This one is managed by Martin Currie, which are a very well-known active manager. Basically invests in high-yielding Australian shares. The aim to give you an income yield above the ASX 200 and also identify companies that not only have a good dividend yield but are likely, should be able to grow that dividend above the rate of inflation over time. So at the moment that's forecasting a franked portfolio yield of about 7% as at the end of April. The other one is RINC, and this is a broad property infrastructure exposure. So many people would invest in listed property. This basically gives you some exposure to listed property, commercial property, but also exposure to things like utilities, toll roads. So it's really a broader exposure to real assets. Again, it's a link to, and it's something that I guess it has more of a defensive quality too. Typically, these sort of exposures don't weaken as much when equities sell off. Because the income that they offer is relatively more reliable based on long-term contracts tied to the rate of inflation. So that's offering a yield about 5.7%, fully a franked yield, I should say. So that's another one if you want property infrastructure exposure, all wrapped up in a nicely diversified fund. We haven't mentioned for a while, but again, in this environment where franking credits are now, the risk around franking credits has been removed. Those that are seeking income and good, attractive franking credits is the Harvester Fund. And this is a fund which basically invests in a portfolio of stocks and rotates them every couple of months so that the company is just about to pay a dividend. We hold those stocks, we collect those dividends, which we then distribute onto investors, and then we buy into the next round of high-yielding Australian shares that are about to pay a dividend. So, end of the day, it should over time give you a return similar to large cap shares in the Australian market, because that's what it's buying. But you'll get more of it's designed to give you more of the return via income than capital. It also has a risk management overlay, such that if volatility in the equity market increases, we reduce our exposure to the market, our net market exposure, so it provides some downside protection in big equity market sell-offs. But what I would also point out that the favouring income versus capital can mean that the capital value of Harvester can decline in periods, and so you may see the price of Harvester decline. So you are trading off income versus capital. And if you want to limit any potential capital decline, you can have a dividend reinvestment program to sort of not fully collect all the income and partly reinvest in some Harvester units to bolster the capital side. But all those caveats in mind, just it does offer quite an attractive income return. So if you're looking there, so that as at 30 April, you're getting a cash yield of 9% and franking of about 3%. So you're looking at fully franked a return of around about 12% in income. So look, there's a lot of bells and whistles in that fund, and if you are interested in that income opportunity, definitely have a good look at our website and the product disclosure statements associated with that fund. Hybrids is another one. Again, we just point out that it does sit nicely along the risk-return spectrum. Hybrids have qualities of both equities and bonds, so it does sit somewhere between fixed income and shares in terms of risk and return. And just to highlight on the next slide the way that hybrids have held up pretty well against bank shares, and certainly since the GFC. So you look at bank shares; these are the declines, the peak to trough declines in bank shares over the last few years, and hybrids, really they've held their own pretty well over that period. So they offer you good yield with a defensive exposure in periods of equity market weakness. The last one to mention is, again, going back to the idea that the capital gains discounts available on long-term investment have been preserved. So those looking for low-cost exposure to the Australian share market and just to get long-term capital gains over time, we have brought to market quite a revolutionary product, A200. Gives you broad exposure to the Australian market at the cheapest cost really in the world. For those that want broad diversified exposure to the Australian share market, we're offering a fund with a management fee of only 0.07%. And yes, that decimal place is in the right spot, 0.07%. As you can see in that chart, it does broadly offer similar returns to other broad Australian equity market benchmarks, given its design, such as the, I guess most well known as the S&P ASX 200, but also the MSCI 200 index as well. So you should expect to get broadly similar returns to those indices over time at a very low cost. In fact, that management fee is half the cost of the next lowest cost broad Australian equity benchmark in there in the market. So we're very proud of that fund, and it's actually been incredibly popular since it was launched a few months ago. That's it. 5 minutes or so time for obviously some risks to consider. I should mention, as I said, all these funds have product disclosure statements associated with them. If you want more information, definitely have a read. Also go to our insight section of our website. There's a lot of information on various funds that we do put out from time to time. Take on board all the various risks associated with these investments, the market risk, the currency risk, the interest rate risks. Certainly, and again, just to emphasise, this has been general information only, obviously not aware of your own personal circumstances. So, and last but not least, just we're moving on to questions.
Yes. Thank you. Thanks, Ed. We've got quite a few questions here, so we'll try and get to as many as possible. There was one, do you believe the RBA cutting rates will further inflate the debt bubble and hit housing prices again when rates eventually rise in the next 2 or so years?
Very good question. It's a very, I think it's a big concern at the RBA as well. I mean, I think, look, if you look at what's happened with the market, I mean, partly what's happened in the Sydney market over the last couple of weeks, we've had a big rebound in interest in the property market. It's partly because of the expectations of lower rates, but it's largely because of the, the election being over. I think investment property has opened up, and also the banks. There's been a reduction in the hurdle rate that homeowners need to pass. The sort of, you needed to be able to service a mortgage on a 7% mortgage to get a loan. They've lowered that now, so more people are being able to get loans. So banks have eased up on their lending restrictions, which has caused that rebound. Bottom line, look, I think the market is still going to be subdued, but you are right. I mean, it's unfortunate. I mean, we are going to basically probably see, debt levels rise somewhat more. People are going to, be borrowing into the market, but at the end of the day, we need to bolster consumer spending at the moment. Or the RBA's objective is to try to get inflation up, try to avoid the economy having a big downturn, try to avoid unemployment pushing up too far, because that would actually, spark a bigger debt concern. And interest rates are a lot lower than they will be over the longer term, which is not ideal. But end of the day, the RBA's got to do what it's got to do when it's facing a weak growth environment.
Okay. Thanks, Dave. You spoke a lot in the first section of the webinar about the UK. Now, what is the best ETF for UK exposure?
Well, it's a good question. There are not a lot of UK ETFs, I would say, in the Australian market. So it's not easy at the moment to get UK exposure. There are some European equity ETFs, but at the moment, my understanding is there's no direct UK ETF at the moment. But watch this space. There may well be one in the future. I mean, it's definitely an evolving area. We have a pound. I mean, if you want to take a currency view, you can invest in the UK pound, and we have an ETF on that. But again, I think there's probably a bit more. You just have to see how the Brexit thing will pan out, because it may be a situation where the UK does get worse before it gets better. Certainly, if there's a hard exit later this year under Boris Johnson. We'll just have to see how that pans out.
Cool. Thanks, Dave. Do you have a view on the US 2020 election impact to the market?
The US election, as in the presidential election, I would imagine?
Yes, I think so.
Yeah, look, I hate to say it, or we'll have to see who the Democrats put up as a rival to Donald Trump, but I mean, I think that you'd be hard to bet against Donald Trump at the moment. I think actually he's going to probably win the next election, which will be, the markets, I think, have going to get used to him, really. At the end of the day, he's a Republican president. He favours low regulation, low tax. He favours, fiscal stimulus. These are the sort of things that Wall Street likes. So I don't think it's going to be a big negative effect. I think the markets are actually sort of almost pricing in that he will get re-elected.
Dave, you didn't actually talk much about it, but do you have some thoughts on the potential slowdown of the Chinese economy and the impact on our market?
Yeah, I didn't mention China today. There's a lot to talk about today. I did mention it briefly in terms of those PMI indicators right up the front. If you look at the manufacturing indicator for China, it is quite weak. And China has slowed down. Look, the points I often make about China is slowing down structurally anyway, because it's just becoming a richer country and the scope for productivity catch-up is less. And the slowdown last year was partly policy driven. It's trying to clamp down on credit growth, particularly from the so-called shadow banking sector. And it does retain the capacity to stimulate its economy through infrastructure programs and a further easing of credit conditions if it need be. So at the moment, most of the Chinese slowdown I think we're seeing is still acceptable to the Chinese authorities. I don't think they're getting overly worried. And were they to get overly worried, they would respond by policy measures which would continue to support the economy. So I'm not anticipating a big slowdown in the Chinese market such that it would, have a big negative impact on our economy. I think, the good news is that China cares deeply about its growth and it has the policy levers to continue to support the economy for the foreseeable future. And in fact, one lever it could pull if trade wars got nasty is devalue its currency in a big way, which would upset the US no end. But it would be, beneficial for the Chinese exports.
We've just reached our time limit, and there's been quite a lot of questions, and we will answer them directly if we haven't had a chance to get to them. But as Dave mentioned before, he does produce a weekly snapshot. Bassinese Bites comes out on a Monday morning and really sets us up for the week ahead on those economic grounds. We did have a question about an India exposure, and a great question because we've actually just announced that we will be launching an India ETF. If you'd like to go to our website, there is a sort of option for you to register your interest in that, and we will send you the details and update you as soon as that comes to the market. So we will be launching a quality India ETF shortly, so stay tuned for that one. As I mentioned, everyone will get a copy of the presentation and the slide deck, and we really thank you for your interest and your attendance today. Another great quarterly economic webinar from David Bassinese. So thank you very much.
Thanks, everybody. Talk to you next time.